The Federal Reserve just sent a message to markets, and it was not the one investors were hoping to hear. The Fed held its benchmark interest rate steady at its latest meeting. That part was expected. What caught attention was the tone. Officials paired the pause with language that leaned more cautious than markets had anticipated. It is a posture sometimes called a hawkish hold, when a central bank stops raising rates but makes clear it is not ready to cut them either. The message, in plain terms, do not expect cheaper borrowing costs anytime soon. That distinction matters more than it might seem. When investors believe rate cuts are coming, they tend to price assets higher. Lower rates make future corporate earnings worth more in today's dollars, and they push bond prices up. A Fed that stays cautious for longer removes that support. Stocks can drift lower. Bond yields can stay elevated or climb further as investors demand more compensation for holding debt. The Fed is navigating a genuinely difficult stretch right now. Inflation has fallen considerably from its peak, but it has not returned cleanly to the central bank's 2% target. At the same time, the labor market has been cooling gradually, but not sharply enough to push officials toward easing policy. That combination gives the Fed reason to hold. It does not yet give them reason to pivot. For everyday investors and households, the effects are tangible. Higher rates for longer keep mortgage costs elevated. Credit cards, auto loans, and corporate borrowing all stay more expensive. The ripple effects reach household budgets just as much as trading floors. Markets were already expecting a cautious Fed going into this meeting, but the tone coming out of it is sharpening a debate that has been building all year. Just how long does higher for longer actually last? The honest answer is that no one knows with certainty. What is clear is that the Fed is not moving on a schedule. It is moving on data, and the next major readings on inflation and the jobs market will carry more weight than any policy statement in setting the direction from here. That is the practical point to hold on to. The Fed's next move, whenever it comes, will be driven by what the inflation and employment numbers show over the coming weeks. If inflation keeps easing and the labor market softens further, the case for cuts builds. If either of those trends stalls or reverses, the cautious stance hardens. Keep those two data releases on your radar. They are where the real signal will come from, not the Fed's words. This briefing is brought to you by First Financial News, clear daily coverage of the economy and markets at firstfinancialnews.com.